Hello, everybody, and welcome back to CNF Talks. This afternoon, it's a great pleasure to have with me David Petrie, who's Head of Corporate Finance at the ICAEW. David's going to be joining us at the M&A Summit, which is being held on the 21st of October in London. David, welcome.
Good day, Morris. Good afternoon.
Very good to have you with us. Let's turn to our first question, which is a sort of retrospective, if you like. The M&A market has been or was in the doldrums for a number of years following the pandemic. What do you think were the underlying factors that contributed to that?
Well, I think perhaps the best place to start with that question, Morris, is just to go back just a touch further to what actually happened during the pandemic, because therein lies the answer to your question. So the first thing, of course, that firms did certainly when we went into lockdown was to look inwards and think primarily really about how they can survive.
Yeah.
So that which was very rapidly followed by where are the opportunities for us, given the situation that we find ourselves in, that once we've managed to fix things and we're pretty confident that the firm will survive. And a number of CEOs also took the opportunity to do a certain amount of internal restructuring, working on the maxim, never let a good crisis go to waste. So for a little while, a number of firms spent quite a bit of time looking inwards, but then very quickly, actually, opportunities started to present themselves, partly because a number of firms were struggling, because not that they were bad, but simply that demand went away because normal trading patterns were so severely disrupted. And this then led people to very quickly realize it was still possible to do M&A, to do deals without actually spending much, if any, time at the company or with the targets. So and private equity, of course, still had money to deploy, and so we found ourselves in the situation where it really moved from very little activity for the first month or so to a great deal of opportunity and M&A activity. Some of it opportunist, which I hinted at a moment ago, but some of it actually strategically driven and looking forward to a post-pandemic world, which, as the crisis wore on, became clearer and clearer that that was what was going to happen. So by 2021, deal activity really peaked, and after at that level of peaking in activity, there was a little bit of a runoff in activity as advisors were exhausted, and sometimes very hard to get teams to do due diligence or legal work because simply they were sold out doing other jobs. So after every peak comes a trough, and so I think there was some of that which led to the slowdown. But then, aside from that, I'd say that there were some other macroeconomic factors to consider, or global factors, and those would be economic uncertainty started to take hold in many countries, both in the UK and in the US and in Europe. Geopolitical issues, the war in Ukraine, disturbance in the Middle East, and rerouting of global shipping routes away from the Suez Canal and so on. This, of course, also is supply chain disruption. So another major issue, making it more difficult to forecast performance for many manufacturing businesses. And then, of course, regulatory challenge as well on top of all of that, with some antitrust situations in the US. So a lot of stuff going on, which could have contributed to overall market uncertainty. And markets don't, M&A, private equity just doesn't like uncertainty. So pretty uncertain situation.
Yes, and of course now things are looking up, and many people are sort of calling a turn in the market and expecting the autumn to be very productive. Do you think that there's a sort of sense of renewed optimism? There's an improving economic situation, perhaps a more stable political environment, and the recent reduction in interest rates. Do you think that all of these together are catalyzing this upturn in the market that people are expecting? And do you think there are other positive factors that are playing into this currently?
Yes, I do. Definitely, our members are reporting an increase in WIP, and they're also from the
Mm,
start of the year, there's been the general economic forecasts of a reduction in base rates, which we have now started to see. How much
mm,
further that will come down remains to be
yeah,
seen. But we've
yeah,
moved from a situation of relative political instability to a situation where there's a majority government. So at least in the UK, there is some certainty over that
mm,
going forward. So we've moved possibly in the UK from one of the more politically uncertain environments to perhaps one of the more certain environments. So
yeah,
I think from that perspective, that's very encouraging. And I think there's some other things going on out there as well, Maurice, other than just making the cost of capital a bit cheaper. I
yeah,
think there are some other fundamental drivers, and I think probably one of those is on valuation. Members are telling me that the gap is closing now between the expectations of buyers and sellers.
mm,
And there's also a greater acceptance in the market of earn-out arrangements or deferred considerations, which can be used, which became very popular during the pandemic when people were basing earnings expectations on variously complicated measurements of
mm,
profitability. EBITDA was popular, which of course was earnings before depreciation, interest, tax,
yeah,
oh, and
yeah,
COVID. So
yeah.
we've
Okay,
now become
I like that.
used to that.
Yeah,
We've now become used
yeah,
to adjusted earnings and mechanisms for closing gaps on valuation in
mm,
transactions. So the advisors are playing an important role in bridging the gap there.
mm,
And I think we've also got some stuff going on in various sectors. So, there's a lot more optimism probably returning to real estate and
mm,
particularly certain areas, logistics, data centers, those sorts of areas. And we're also seeing upturns in well, tech never really went away, but fintech again, very
yeah,
popular, healthcare.
yeah,
So there were certainly strong areas of buyer appetite and interest. And then we've got some other drivers. Energy transition is making
yeah, of course.
assets
Yeah,
associated with the transition to net zero particularly attractive for buyers.
mm,
And and there's always our old favourite, which is the supply of money and the supply of capital.
yeah,
And
yeah,
no discussion on the market, as you and I know,
yeah,
is is complete without mention of the word private equity
yeah,
and dry powder. And they
yeah,
are, of course, sitting on several trillion of institutional capital waiting for it to be
mm,
deployed. And many
yeah,
institutions are becoming impatient. So
mm,
there's clearly a driver for private equity to continue to both dispose of existing portfolio companies and invest in new
mm,
ones. So there's a lot of things out there which are really starting to put some pressure into the system, and yeah, I think the future is looking good, and we're certainly hearing from people that they're significantly busier than they were last year, and that's starting to flow through in completed transactions. So the numbers are starting to come through as well.
yeah, yeah. So the private equity side, just to pick that up for a moment, that seems to have a sort of a dual function in terms of its impact on the market. On the one hand, they're portfolio companies that they had to hang on to those for a lot longer than they had anticipated. And on the other side of that equation, they've got investors wanting their actual sale and return. So I guess that's feeding into quite a few trade sales. And as you say, on the other hand, they've got lots of dry powder and they're looking for new acquisitions. So how does that play out between those two parts of it, or is it very hard to separate it out? Which is the key driver, the selling off of current investee companies, or the dry powder that needs to be deployed fairly swiftly?
I think it's probably a bit of both, Morris, and from the deals that I've, just looking at everything that happens day in day out as I tend to do, and thinking about what were the drivers behind this. Probably a bit of both. In some end it depends where funds are in their investment cycle. It depends
Yeah.
a little bit about the sector as well, as to what is attractive and what is maybe an opportunity to dispose of an asset. And of course,
Mm.
for still we've got the situation where for North American buyers, UK companies are still looking relatively cheap due
Well,
to the
yeah,
strength of
yeah.
the dollar. So we've got quite a lot of factors going on there, and also in some cases we've got European purchasers looking to diversify into what is
Mm.
now a more stable market. So it's
Yes.
there's a lot of things there,
Mm.
and each will be unique to a particular deal. But there's certainly more positives than there are negatives at the moment.
Yeah, absolutely. One of the features of the markets for some time now has been some take privates. And a lot of people, as you mentioned, the valuations, from a North American perspective, the UK market's relatively cheap. And the UK market seems to trade at a discount to other stock markets, not just the US. Do you think that this, or the action taken by the government and the authorities to try and reposition London's capital markets is going to work, or do you think there are going to be more take private transactions, notwithstanding a general rebound in the M&A market as a whole?
Well, I think the unfortunately, I mean, we difficult to answer that. There's a number of questions in there, but I think the general question was is do I think these changes to the rules are going to make any difference? I
Mm,
think it's the thing that
yeah,
everybody in the city is asking that question and hoping that the answer is yes. The reality is probably quite a bit more nuanced than that.
yeah,
There are some changes which should certainly make it more straightforward. We've
mm,
spent a lot of time in the institute collecting our members' thinking in that, because our members are, of course, the people who prepare the long form reviews that are necessary for a company seeking a listing, and also do an awful lot of work on the lead advisory side as well.
mm,
And with mid-market companies, there is still the option of getting the equity capital from private equity.
yeah,
And for all the
yeah,
reasons we were just talking about, there's an awful
mm,
lot of that about. So there are different options. There's
mm,
no doubt that being a listed company brings with it significant continuing obligations when it comes
mm,
to financial reporting and corporate governance.
yeah,
And but on the other hand, that's also true of private equity owned businesses. It's just
mm,
different in that private equity managers want very comprehensive management, accounting information, and KPIs and so on.
mm,
Whereas arm's length institutional investors that buy the stock that's listed on a London capital market
yeah,
look after their investments in a slightly different way, but they also need regular information and clear compliance with regulation that's appropriate for arm's length investing. So
mm,
it's just a different dynamic.
yeah,
The reality is that companies should raise equity where it's likely to suit them best, achieve the best
yes,
value, and work best for the business. And and the rules that go around that will be something that they deal with.
mm,
Yes, it might slightly tip the balance in one way or another, but uh,
mm,
if a listing is the right option, then companies will tend to put up with the additional cost and the additional hassle in order to get the best results. So Changing the
Yeah.
rules, unfortunately, and I would that it were otherwise because of the amount of time and effort that has gone into changing
Mm.
them, but unfortunately, it's not going to make a massive difference. Investment
Yeah.
fundamentals are always the most important thing.
Absolutely. Absolutely. Very interesting. Very interesting, David. I've enjoyed this chat very much. For our viewers, if you want to learn more about these issues and many related ones, please do come along to the M&A Summit being held in central London on 21st of October. More details are available on our website, cityandfinancial.com. So please do check in there for further details. And David, I wish we had more time. Sadly not. Thank you very much indeed for sharing those insights this afternoon.
Pleasure, and I look forward to continuing the discussion at the conference.
Excellent. Thank you.